How much house can you actually afford? In this video, we're going to talk about down payment expectations, debt to income, as well as how to calculate your monthly mortgage payment. My name is Travis Anderson. I'm a local realtor here. I help both buyers and sellers in Minnesota and Western Wisconsin. Let's get right into the video. First and foremost, when calculating how much home you can afford, we need to talk about the down payment expectations. In Minnesota, you can buy a home for as little as the earnest money. That would be around $1,000, but it's a negotiable item, so it can be as high as the down payment. And if you're a veteran or if you're buying in a rural area, you can do a zero down program. There's also down payment assistance programs available in both Minnesota and Western Wisconsin that you can take advantage of where there is a down payment, but you're not required to bring the cash to closing. And so as far as the down payment goes, look, 0% down is an option. 3% down is sort of your like minimum conventional type product. That goes all of the way up until 100% down cash, where on a conventional mortgage, you can put 5%, 10%, 15%, 20%, etc. And then we have your FHA style mortgages, which will require 3.5% down. But when you're calculating your down payment, you're going to want to first, you need to know what type of a mortgage you're obtaining. If it's a VA, or a USDA loan, it's 0% down. If it's a low down conventional product, it's either 3% or 5% down in most instances. If it's an FHA loan, it's 3.5% down. And otherwise, if it's conventional, you can sort of choose your down payment, 5, 10, 15, 20%, what have you. If you're buying an investment property, you're probably going to want to look for 25% down or more. That's not universally true, but it's a good way to start calculating your down payment. The next thing we need to look at is what's called your debt to income requirement. Now, your debt to income is going to be your total debts, including your mortgage, including your car payments or student loans or credit cards, all of those monthly debts added up, divided into your gross monthly income. And the debt to income for conventional mortgages at the time of recording this video is 36%. And so let's use some really easy math. If you have a $10,000 a month income, then you can use $3,600 of that income to your total debts, including your mortgage. So if you've got a $500 car payment and a $100 student loan, you can now use $3,000 for your mortgage. Now, FHA, the debt to income is actually higher. I think it's around 42 or 43% right now. So again, if it's $10,000 worth of income, $4,300 can go towards debt. But when you're calculating how much home you can afford, you want to know what the debt to income is, 36% or so for conventional, 42% or 43% for FHA, and you're going to need to calculate what your debts are and then subtract those debts from that calculator, and that will give you a better idea of what you can afford for a mortgage payment. The next step would be, of course, calculating the mortgage. Most websites have a fairly decent mortgage calculator. They're going to go ahead and calculate the principal and the interest of the loan, and any mortgage calculator does that very effectively. And then you're going to want to make sure that the taxes on that property are in that payment calculator for most of us, as well as the homeowner's insurance. And I see that on most mortgage calculators being way under calculated at maybe $50 or $60 a month. At least here in Minnesota and Western Wisconsin, we're looking at that being $100 plus, depending on the size of your home. And so you're going to need to make sure that the taxes and insurance are calculated into that mortgage calculator. And then the third thing you're going to need to make sure is accurate is going to be what's called your mortgage insurance, which is separate of homeowner's insurance. Homeowner's insurance protects the home from obviously risk assessment, and then mortgage insurance protects your lender from risk assessment. And so most mortgage calculators are not calculating those things accurately. They're all calculating the interest and the principal pretty accurate, but they're not calculating everything else accurately. Be sure to take a look at that and make sure you're adjusting those things accordingly. And then if you've got any other questions about this, my advice is let's reach out to myself or reach out to a mortgage company where they can provide you with a loan estimate. And that's going to give you a much better idea of what you can afford and how to calculate the cost of buying a home. My name is Travis Anderson. If you've got questions, do me a favor, give me a call, shoot me a text, hit me up in the comments section. And as always, all my best to you and yours.